Baluga, luga, 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 luga.
Luga, luga. Luga, luga, luga.
Luga, yeah. One maluga, four lugas.
All right.
Okay.
Hey guys, Rafi here from the Endgame Investor, and today we're going to talk about debt. How subprime car loans, student loans, and credit cards delinquency levels are all above the 2008 peak, which means that any little thing could disturb the humongous bubble that continues to build in tech stocks and AI stocks, in the South Korean stock market, and the Israeli stock market, and stock markets around the world that aren't currently yet hyperinflating. I'm not going to go into the reason why the bubble is expanding now. I go into that on the Endgame Investor on Substack. Link to the post in the description below if you want to know what's going on in the plumbing now that I didn't anticipate, but it's happening. And people ask me this question. They say, Rafi, why is it that if high interest rates generally strengthen a currency, or the higher you go in interest rates, the stronger a currency is? Why is it that high interest rates will destroy currencies this time? Why are things different now?
Why is this night different from all others?
Because.
Well, the answer is that higher interest rates can increase the strength of a currency if it doesn't lead to defaults in the debt. As interest rates were hiked in the late 1970s and early 1980s up to 15% by the Federal Reserve short term, then it encouraged people to hold debt, to hold currency, because they received more interest on it if that interest could be paid. But now, as they hike rates across the world, no country, especially no Western country, can possibly pay the rates that they are being hiked to, and therefore the debt will default and go to a value of zero. And since most of the currency actually is debt because of all the quantitative easing that has been happening since 1981, when they last peaked rates at about 15%, it's going to lead to a global wave of defaults and destroy all currencies simultaneously. This is why, as consumer prices continue to accelerate what people call inflation, what Keynesians call inflation, but is really just rising consumer prices, they will have to continue to cut into those rising prices, and that will lead to the death of the currency, because the other way is they keep hiking rates, and that leads to defaults of debt anyway, and it destroys the currency. There's no way out. Either way they go, it's a hyperinflationary endgame, and that's it. Before we get to the slides, this is brought to you by my Substack. Check it out in the link in the description below. We're going to talk about the plumbing over there in the next post. And it's brought to you by the Dirty Man Safe. Use the code ENDGAME10 at checkout for 10% off. You'll need some gold and silver with you to get through the end game. How much is up to you, but the best way, or the most low-tech way to store it, would be a Dirty Man Safe. Just don't tell anybody about it, and you'll be cool. And get your gold and silver at Miles Franklin. Link in the description below, and mention the Endgame Investor, and can take some of your gold and silver and store them with monetary metals for interest in gold and silver terms on your gold and silver holdings. Obviously, don't keep it all at home with you in a Dirty Man Safe. Use some to earn some interest with Keith Weiner and Monetary Metals. Use the link in the description below. We're going to start with silver, because I know you all love silver. So I took here a weekly candle chart going back 3 years, I think. Yeah, it looks like 3 years. So we see here's silver's rise in dollar terms, and we have a major triangle going on here since August of 2025, and we are reaching the apex of that triangle right now. You can see here is the lower trend line, here is the upper trend line, and we're reaching the point here where something is going to happen up or down. The reason that I think it's going to be up is that we've been coiling for 9 straight weeks just above the 20 EMA. That's the exponential moving average. That's something that I don't normally follow, but stock charts just put it in here on the default, and I think it looks pretty compelling.
Does it compel me? It's not that compelling.
1, 2, 3, 4, 5, counting candles, 6, 7, 8, 9, and this would be the 10th candle this week. The last time we saw that was over here, April 2025. That was the last time that silver was below $30 at all. And we had here a 1, 2, 3, 4, 5, 6, 7, 8, 9 week coil just above the same line. Does that mean the same thing is going to happen now? No, it doesn't, but it's happened before. And at some point, it's going to happen again. Is this that point? Well, I guess we'll find out pretty soon. Next slide. Silver holding at the 2020 highs versus the CRB. The CRB is a very old index of commodities going back to the 1970s. And you can see here that, yes, silver has declined. It's declined relative to a lot of stuff since the top at 120, which is over here. But it has kept its 2020 highs relative to other commodities. We are now at about 0.2. And how does that look long term? Well, we have the long term chart going back all the way to 2005 over here. And we are not only above the 2020 highs, we're above the 2011 highs. We're above pretty much all highs except for the recent highs that were hit at 0.38 when silver went to $120 an ounce. So we are, you can see here the tight coil above that same line right here, on the right side. But the point is that yes, silver has declined, but not relative to other commodities. It continues to rise relative to other commodities because its monetary characteristics are slowly being peeled back like an onion.
You're like an onion, an outer layer of cocksucker, and when you peel it away, there is 10 more layers of cocksucker underneath.
What about versus stocks? How is silver performing versus stocks during this correction from $120 on January 29th? What is it? January 30th? Something like that. Well, we're still holding way above the 2020 highs relative to the S&P 500. And it looks like we have support over here at about 0.01. We have gone down by about half, 0.175, and that has to do with the extreme bubble in AI stocks, which will burst at some point, and when it does, it's not going to be pretty for a lot of people. So what about the gold to silver ratio? Well, we see here something pretty interesting that we're holding below 60. The lower this is, the higher silver's value is relative to gold. And so while we do see a correction here from a low of 45, well, that's cool. There's like an arrow here that spontaneously appears. I didn't know that could do that. I don't know what is causing that, but I think it knows. I think there's like something in my computer and it knows where the gold to silver ratio hits its low right here. Wow, that's amazing. So below 60, and you can see here we are trending down still below this, again, 20 EMA on the gold to silver ratio. So we are healthily below the 2021 low here in the gold to silver ratio, which means that silver is not really losing much value relative to gold. Both metals are in corrections right now, but silver not so much relative to gold. It still seems to be the leading metal. Subprime car loan delinquencies all-time record. I didn't know this, but I ran into it on Trading Economics. It says here the share of U.S. subprime borrowers at least 60 days behind in their auto loans declined to 6.8% in February 2026, easing from 6.9% in January. So technically, the all-time record was in January. Now we're back down slightly to 6.8%, but you can see here the trend is clearly a lot higher, and this is where we were in 2008. We're well above that now. Car loan delinquencies are higher than they were during the 2008 financial crisis, and it's not just car loans. It's also credit card and student loans. They're both higher than they were at the 2008 peak. You can see here is the comparison. While total debt balance in delinquency was much higher in 2010 than it is now, you can still see here that the biggest difference is mortgage, right? And the reason for that, why aren't there high mortgage delinquency levels? Because a lot of people locked in their rate in 2019, 2020, and it's really the banks that are getting screwed because they have to maintain those rates if they're locked in, whereas it's the banks that are losing money on the mortgages rather than the people that live in the houses. And that is arguably worse for stability, and it's going to collapse at some point. But we can see here, credit card is at 13.73 delinquency. Now we're about the same, 13.12. It's around the same area that we were in the 2008 financial crisis. And since this is the peak, you can say, yeah, it depends how you count it, but we're basically at that same level. Auto loan 5.01, now 5.6. Student loan 8.66, now 10.34. In a lot of ways, we're in a worse situation now, debt-wise, than we were during the 2008 financial crisis, which was triggered by debt, and so will the next financial crisis be. Hormuz is now super ultra mega blocked. This is the latest screenshot from HormuzStraightMonitor.com. You can see 0 trips transiting now, 0 throughput, 0% of normal. This is pretty bad, and according to Chevron and Exxon CEOs and other big head oil honchos, we've got a few weeks before oil spikes to about 150 or so. They could be wrong, but this is what they're saying because inventories of spare oil in the Western countries are at spectacular lows and they can't go much lower without triggering a huge price spike, which is going to have to force demand destruction. We'll see if they're right. A double inflation wave sparked by oil war. Remember the 1970s? Well, that was a double inflation wave sparked by an oil war. It sounds pretty familiar. So we have here in 1973, this starts in actually 1972, to the peak in 1970, late 1974, early 1975 was 30 months. That was the first wave. Then we got a 24-month lull from 1975 to about 1977. 24 months, about 2-year lull, and then we have the second wave over here. The oil war was actually 1973, the Yom Kippur War in Israel. And now we have the same kind of thing, the Iran war involving Israel causing an inflation wave. But there were two here. There wasn't just one. The war was only a 3-week war, remember, in 1973. So this one has been a little bit longer. Could cause a worse problem, which it probably will. Or cure, because we all need this monetary system to end. In order to do that, we need the dollar to die, and we need oil to rise for that to happen. So the double inflation wave sparked by oil war. This is moving the same chart from the 1970s to now. And now I don't have information beyond this bar here in 2026 because I'm not from the future, despite what people think.
I'm from the future. I came here in a time machine that you invented. Now I need your help to get back to the year 1985.
So we have wave 1 here, starts in June 2020. It's close to the length of the first wave of the 1970s, and then we have the longer lull here. But here is this the start of wave 2, sparked by an oil war. Here, the oil war continues. Here, the oil war could be responsible for the second wave rather than the first wave. The first wave was triggered by what? A virus war. The one that saved everyone's lives. Thank all of the health professionals, etc. Thank you, COVIDiot, for saving all of our lives. And the last slide I'll get into is from Reuters. Unrealized losses at U.S. private credit lenders deepen. It's getting worse for the private credit catastrophe. And this article is by Paturaja Ruga Bhupathi.
Maluga, luga, 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 luga. 1 maluga, 4 lugas.
All right. Why don't I just call you Bob?
Don't know.
A Reuters analysis of 51 business development companies, or BDCs, better than BDSMs, showed aggregate unrealized losses equaled 2.35% of net asset value in the first quarter of 2026, the steepest quarterly hit since the second quarter of 2022. BDSM unrealized losses hit worst levels since 2022, it says. So the private credit catastrophe is not over, it's getting worse. And that's all I have to say about that. Gold and silver are boring now, which is probably why you should stack if you haven't stacked yet now, rather than when they are being bid up by monetary panickers. So get your gold and silver at Miles Franklin. Get your dirty man safe. Use the code endgame10 at checkout, and check out the Endgame Investor on Substack for a discussion of the plumbing and why short-term interest rates are plummeting specifically now. There was a rule change that took place and that is now taking effect. How long is it going to last? We don't know, but it's not going to last forever because eventually there's going to be an end to this system and we're going to go back to money rather than credit because there's nothing else to go back to divide the division of labor.
Anyone famous named Bob? Maluga, luga, 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 luga.
I doubt it.
Good.